Welcome to Erik Penser Bank. My name is Jonas Thulin. I'm head of asset management, and I would try to keep this English version short. I'm struggling very hard every week trying to select as few slides as possible. For some reason, I can't make it below 25. But I keep it swift. There's a longer version in Swedish. You have the full PowerPoint package on our homepage and also on my social media pages. So let's kick off. To the left, you see a little bit of the issues that we are right now working with. We don't have to go through the performance, but the whole agenda for us is the supply bottlenecks and the speed by which they are evaporating right in front of our eyes, and how that impacts the pricing of inflation, pricing of Fed fund futures, etc. I would even call it a bit dramatic moves that we've seen in Fed fund futures, etc. All the while, we still have a huge support for equities. So we haven't adjusted our portfolios to protect more. We haven't taken off more positions. We still have our cash position that we look to set to work, hopefully this week, as we go through. We have left the option expiry behind us. We have some dry powder, basically. We've added emerging markets in China to our sustainable portfolios. They just happen to fit them a bit quicker than the rest. But we're definitely looking forward to the US are reopening after President's Day, and see if this is going to be the 9th month in a row that we're going to see a turnaround Tuesday. The underlying structure for equity market is, as I say, still supportive. Now, the performance, very briefly, we were taking a bit of beating in the beginning of the year, but we are holding on to tech growth, and I'll explain that a bit later. As of late, that has been a bit rewarded, not quite enough yet in our mind, but we still are working on that, of course. But we don't really want to just give up. We have about 25% excess return compared to the global benchmark, and I really don't want to give up more than a few percentage points of those until we start to work heavily in the portfolios, as we've done in the past, trying to always build for potential rebounds. Now, critical elements of CPI. Now, the CPI, I would even say, regardless of the instrument you're looking at, inflation swaps or break-evens or traded inflation expectations, they're all coming down quite aggressively. Inflation swaps are back to levels we saw in September. Here you have a 5 break-evens, which are back to levels we saw in 2020. And this trajectory is, of course, key for the market, and the underlying reason is even more key. On the left-hand side, I have put a dumb silly indicator in for owner's equivalent rent of residence. We'll see if that peak holds. I'm not really too happy with this indicator yet, but we're working on it. But I think the key point here is, of course, that the whole CPI pressure has indeed, as we've been arguing for quite some time now, peaked in Q4 as of last year. Now, we have various measurements of supply bottlenecks. You can see 3 of them here on this page, where you have Reserve Bank of Kansas, you have Mid-American PMI, you have New York Fed's global supply chain pressures. And regardless of the instrument you're looking at, you still see the same kind of evaporation or peak formation. Now, if you stretch this a bit further, if you look at Baltic Dry Index, and especially if you look at port activities in the US, you can actually see that the speed by which the supply bottlenecks are leaving us or are being dissolved is a lot more rapid than the speed which it took to build them up. Basically, we had a huge period where we can anticipate higher and higher CPI pressures. And if you remember last year's value to growth rotation, etc., etc. But now things are happening a lot more dramatically on the downside. And I think that to some extent is being missed in the market. We haven't really had time to focus on that. The first market to act on this is, of course, Fed fund futures, etc. And there's been quite a reaction there, and I'll come back to that. Now, importantly, we even had days now last week where we had ships turning in and out of the ports in the US without really staying overnight. And this hasn't happened since supply bottlenecks started building. We're looking here at the San Pedro and Port of Long Beach, i.e. LA. In that sense, we can get good data. So the churn rate, which we're able to process vessels now in the ports is really impressive. Now we can look at this from different angles. We can also look at it from a gross margin perspective. You can translate it into that if you look at prices paid versus prices received through each Fed regional areas, all 12 of them. And the data, we can see that it's really hard to see that you have a nationwide upwards pressure in gross margins. Therefore, again, it looks, perhaps we shouldn't use the word transitory, but at least the CPI is sort of a bit hollow in that sense. On the right hand here, I'm looking at the proxy for demand versus supply in the US, and again, rapid build up, but also the collapse on CPI measurements that we can see. That is of course also tied to the oil price. I know that a lot of people are talking about $100 this and that, but for us it's more the annual growth rate that's important, and the way that it has collapsed after the spike is obviously also being translated into break-evens and the curve of the break-evens in the US. Now all this boils down to this graph basically, where I think the market really overcooked this. To the left-hand side, you see where we were a week ago. To the right-hand side, where we were today when we updated this. And you can see pretty much for yourself what has happened to the curve, i.e. we now have 2 cuts all of a sudden in late 24 into 2025. The hump is gone from the market. The entire curve has shifted down between 25 and 30 basis points depending on which contract you look at. And this is, to us, is huge. It's very important. We do not think it has too much to do with the Ukraine situation, that it is still too calm to affect the bigger in terms of Fed policy. But it definitely has something to do with the move in CPI, and becomes more and more apparent, we think, in people's models in terms of what happened to the supply bottlenecks that they are dissolving, and a lot quicker than we perhaps thought, or a lot of us thought. We are holding on to our very dovish Fed forecast for this year. And obviously this is a good reason for us to stick to growth equities whilst handling the downside. We wouldn't stick with growth equities if I hadn't had on an option layer taking care of the downside. I should be very, very honest with that one. Now the financial conditions in the US have marginally deteriorated, but are still positive and supportive. Obviously the situation is vice versa in the European Union, hence we won't see any hikes in Europe this year. I know the market is trying to toy around with a few of them. We don't buy into that. We don't think it's sensible for Lagarde to go out and hike rates where you're already struggling and squeezing the market from a financial conditions perspective. It doesn't make sense to us. Now, it probably doesn't make sense to us. It's probably a very vague argument that doesn't really matter anyway, but it's a weird situation to hike rates. Now, the financial conditions can be, on the previous page I looked at the Fed and the ECB and their own models. On this page I look at my own financial conditions metrics, where we built up on funding rates, supplies in the US and FX swaps. And basically what we like to see here on the dark line is that we don't collapse below 0, and we're certainly not for the time being. In fact, the liquidity in US govies is still ample, I would say. It has turned a bit worse, but then again, from a historical perspective, no, you can hardly see it in the curve. We would be a lot more concerned if something happened on the downside. But if history is any guide, this type of equity blowouts on the downside, depending on political risk, depending on gamma exposure, has a tendency to mean revert quite aggressively. Now, we are a bit thrilled and excited by the fact that the equity flows are coming right on cue from our view of looking at profits and this whole equity market. We can notice that the equity flows into ETFs and mutual funds is very, very positive, and it has been very positive for a long time. And the outflows from bonds has finally arrived. And obviously, this is the swan song of the 60-40 portfolio that we've been speaking about. But it's quite encouraging, especially if you look at countries like Sweden, where we have an equity outflow. We think we are being a bit too pessimistic in Sweden. This is a buying opportunity more than anything else in our point of view. And then obviously we should time it, etc. Now, in terms of gamma exposure, I haven't brought too many slides on that, but I think it's encouraging that our indicator is signaling positive gamma going forward. I had the blowout on the downside. And quite deep blowout on the downside, and now we have the option expiry behind us last Friday, and hopefully we should enter turnaround Tuesday tomorrow. and then we take it from there. And hopefully we're able to put some of that dry powder back to work. And if we're not, we're just going to wait for better timing on that issue. We will keep the hedges though, to take this carefully. For the first time in a while, we actually have a better macro momentum than we have equity pricing. So that means you have a spread now opening up between the macro momentum and the spot prices, which is constructive and positive. You just have to find the right sectors, etc. Now, we are looking at, and it's quite encouraging also to see that the macro environment is not deteriorating, it's actually improving as we're speaking. I think people still have underestimated the super cycles. I perhaps carelessly recall this in terms that we have parallel shift the rate of growth in the US from 2.5% to 5% on a year-on-year basis. We don't see the slowdown as of yet. I think people are surprised by the fact that PMIs in Europe rebounded this morning. We're not so much surprised of that. It's just that we still continuously have this underestimated growth perspective, especially in emerging markets, which we have taken an investment in now. Now, the geopolitical risk is of course on everybody's mind, and we have to differentiate, I think, between risks and threats, and calculate the rolling correlations between those and the underlying equity market. And as you can see now, if you take it on a 30-day perspective, we have somewhat of a tendency of impact on the market. Now, this is a dumb, silly way of looking at things because it's basically a two-variable equation, but it's just to give us sort of a finger point of what could be going on. Now, interestingly, this is more due to risk than threats, so we have to see what happens here. But it's definitely worthwhile looking at. The relationship is not super strong yet, in fact a lot weaker than political risk, domestic US political risk than the Ukraine. And which sort of makes sense from a point of view on the S&P 500, that domestic political risk is more important than the international political risk. I mean, it's been very rarely that the international agenda has been on top of mind of American investors or American citizens. Now the growth momentum is still positive for earnings revisions. We can't really see any breakdown on this perspective again, which is hugely positive. So we don't really buy into this whole negative environment or narrative on earnings cycle. It's coming down for sure, but we don't see a collapse. Now, where we do stick our necks out, and we're probably going to get a little bit of a beating on this one, is on the PMI, because I think it's really interesting to translate the supply bottlenecks momentum into traffic data, which we have on railroads, highways, waterways, and airways, and model the PMI on top of that. And we can see quite a hefty rebound in PMI. We might not necessarily pinpoint and make too much of a bet on this one, but I think it's certainly interesting to see that the same kind of consensus shock or distortion that we saw in European and German PMI data, we can see the same thing in the US. Basically, the consensus is still underestimating the strength of the economy, basically. So we think this is hugely interesting going forward. Now, in Sweden, we have still the situation of the highest systematic stress in Europe. We're still getting on the chin for this. I mean, if you just look at the Stocky, if you look at the Swedish OMX, and obviously the article from last week, international media, about the owner structure between US real estate market has made real estate companies take it a bit on the chin. We have had that in the portfolio. We have single stock exposure by exiting some of those positions. And Erik has more information on that if you're interested. But this is certainly something that is still sort of irritating OMX's performance versus other regions. And hopefully we should be able to correct this in front of the Swedish election this autumn. But we can stop there and save some more time for next week. But at the end of the day, we're still keeping our positions. We have our hedges on, we have our dry powder. We are looking for constructive and optimistic ways of putting those to work, i.e. taking off the hedges and utilizing the dry powder. But also we want really to see the option market, the options expire that we saw last week. I think it was 2.2 trillions in US equity options that were rolling off, which is quite substantially huge impact on the market. That is behind us. We have President's Day today. Tomorrow is the Magic Tuesday, we hope. We'll see what's going to happen then. And in terms of the data, if anything, we think we're still going to get more supportive or constructive, positive way on the US. And importantly, earnings, GDP growth, the macro environment, supply bottlenecks, CPI pricing, CPI outlooks, yield moves, they will also support your equities in our point of view, especially with the growth tilt in the portfolio.